Hello, ladies and gentlemen, and welcome to the sentiment analysis for the week of May 10th. I will be using my own trading as an example of what I expect next week to be like, because I think it is a reasonable and safe way of demonstrating where the market may go. So let's get into the charts, because we're going to be talking about a lot of things today. Let's start with my inventory, the part I highlighted on the screen. This is a grid bot. I take positions at specific levels or intervals. Those intervals are consistent. I'm not trying to chase the market or trying to figure out where the market is going. I'm simply taking positions at intervals based upon a specific mathematical pattern. That mathematical pattern takes into account risk and reward, and it offers an opportunity for this particular pair, EURUSD, that is rare but still valuable. So let's actually look at my activity, and you will see right away I have financing where I have a plus 21 cents to my account and a plus 20 cents. These are often referred to as negative carry. Sometimes they're called swap fees or negative finance rates. Brokers have different words for them. But this is where I am literally being paid to hold this inventory. It's obviously not a lot. It's certainly nothing compared to what I have for risk. So let's actually look at that. Right now, my risk is $823, or specifically my exposure. So if I walk away from the table and sell my grid out, I'm going to lose $823. That's painful. But it is a realization of this type of trading. You don't want to use it on markets that don't have liquidity and volume. EURUSD is arguably the most liquid and volatile market of the entire Forex pair, and it works well in my favor to have that kind of functionality. But there are risks, and as we go to what we discussed last week, where I talked about taking small losses on every single trade, we could actually see that in practice. Here's a trade where I made 42 cents. Pure profit, done, sold off, but right afterwards, I deliberately and intentfully sold 1 unit of my oldest position in my inventory, and I took a loss of 14 cents. That meant that I deliberately shrank the oldest part of my inventory by 1 position. That doesn't sound like much, but as we'll see as we progress with this video, that actually has a huge impact. It's important in the bigger picture. So let's look, and we can see here is another trade. 43 cent profit, 14 cent deliberate loss. It's a pattern that guarantees for every profit I make, I deliberately take a loss. You can't avoid losses. You have to think about that in your trading. At some point, at some time, you are going to make a loss. That's just factual reality. What you can do is decide how you take that loss. I've decided, for the purposes of this system, that I'm going to shrink my inventory by 1 unit for every profit I make. So over time, as my inventory shrinks, my grid moves. It floats closer to the actual current market price. So my grid isn't stationary. It is dynamic based upon the market. But I'm not chasing the market. And that is critical, because if you chase the market, you're going to lose. You cannot predict where the market is going to go, because there are literally thousands, if not hundreds of millions of people in the same market trading, buying, and selling. And that's not even getting into the institutions, banks, or other large facilities doing the very same thing. So from the standpoint of what I am doing, I'm not trying to guess where they're going. I'm simply accepting wherever the market goes and following it, taking off profits as I can. That is the secret to sustainability. Understanding that your inventory isn't always a liability. Now, the other thing is, of course, risk. You have to manage your risk. So if we look at my own risk vectors, right now I have $226 of consumed margin. For Forex, you cannot go above 50% utilization of your budget. If you go above that, you go into a margin call. So my inventory, the highest I can have at risk for exposure is $900. And that means right now my current exposure, my current saturation is 12%. Now I have $800. That's roughly half of my current budget. But again, you have to weigh the reward versus the risk of what you're doing. For the technique I'm using and what I have ran for the last 3.5 years, this fits well for me. It covers my risks and rewards in a reasonable way. So let's actually look at some other charts and really look at where this is going. Let's start with my inventory. Here we can see my inventory very clearly. We can see where I accumulated, where I've been holding, what I've been holding. We can see where the market went up and then back down, where the grid completed a full cycle. For my functional definition of how this system works, a trading cycle goes from the very first purchase to the very final sell. That is when my inventory goes back to zero. So this is one full cycle. The inventory started, I accumulated, I sold off, and then it closed out. One cycle. So that gives me a representation of what my expectations are. So if we look at the current state of the market, we can see the market has been pretty static, which represents what I demonstrated on Oanda itself, this stale sideways movement. But we are at the situation where we could have a breakout. Last week's video had a monthly average of over 1,400 pips. This week's video, today in this video, the market shows the average monthly pips to be about 1395. That's between the highest and lowest of the average candle. That means the market is shrinking. If the market is shrinking, that means we have the potential for a breakout. Whether it goes up or down is a different question. The market seems to suggest maybe an up breakout, but we don't know. What I do know is at this point, I actually reached full saturation. 73 positions, and I thought for sure I was going to be taking stop losses. I didn't, but nonetheless, the possibility is still there. So throughout the entire process, you can see that my average inventory has been within the mid-50s. Now, showing this like this, you clearly see just how the market really pushed up. That huge dynamic push, that bull run. Because I short the market, That has to be part of my mental process. Figuring out and thinking about what happens if the market really grinds against me. Between the hard stop losses and the reductions, that's how I manage this problem. Looking back at the Oanda chart, the evidence of a possible bullish breakout on the chart we can see. Now, whether or not these are going to turn out to be fake outs and the market is going to drop, I don't know. But we can clearly see that we are moving towards something fundamentally changing within the market. Right now, the buyers and sellers are comfortable in the current range. But we do see more activity in the downward direction than we have previously. So the market is suggesting that even though it looks like it might break out upwards, it is likely to break out downwards, meaning that the market is going to drop in price. But really, that is the point of why you don't want to chase the market, because you can never guess it. You can never predict it. So it's just best to follow it. And that is exactly what this chart shows. It shows how I followed the market through the actual trading process of my grid bot. It even shows when my database crash happened. But more importantly, it shows one fundamental thing that is critical to any successful grid bot: an absolute, undeniable stop loss. You must have a hard stop loss when the market goes against you, and that hurts. You must feel that pain, because it's that pain that keeps your bot going. But this chart also shows something else. I zoomed the chart in to really take a look at two critical points. These blue lines represent the actual reductions, and we can see here and here, two different positions were literally burned off through reductions. That is, the grid shrank. Two positions removed from the bottom. That is the most critical point of what this really encompasses. Not that it's going to fundamentally change the market, but it fundamentally changes how you manage your risk, because that's two positions I removed from my inventory without taking hard losses, so that when I did have to take my hard losses, they weren't there. My losses were actually less. So as you look at your risk assessment and you see how you manage your losses, you can see how all of these fit together, so that even if the market pushes ahead of me aggressively, you can see right here versus right here on the chart significant differences from where my grid was and how it shrank my inventory over time. But that's the point. If the inventory is shrinking, the grid is moving closer to the current market price. That means less risk if the market does push against me hard. Now, it's hard to see on this chart, but this chart actually shows all my trades on a daily level. Let's zoom it in. We can see a little better on the daily level, but let's zoom it in some more. Now you can really begin to see a fundamental characteristic of my trading. And this is an important characteristic because it discusses volatility, overtrading, and undertrading. You clearly see through the process how tracking this information can help me actually weigh out how I consider volatility. And that will become apparent in my last chart, where I show my equity, you'll see how I made changes over the course of trading to take better account of that volatility and the impact of that. But you see the fundamental point of what this is. You can actually see volume in the market through the amount of buying or selling and how the market adjusted dynamically. So now let's take a look at the last chart, the equity chart. And again, there's no mistaking the database crash. It is what it is. But there's also some stop losses. And there is a clear shift in how I managed my volatility. Here, I didn't take into account my volatility. Here, I did. By not taking into account my volatility, I made more profit. But at the same time, I had significantly higher and more dangerous risks. Risks that, when you zoom into the chart clearly, it causes problems. We can clearly see how that looks. Database crash, real stop loss. Either way, it's loss of money, and that's the problem. Loss of money still hurts. So when you look at your stop losses, you have to have them. The market moved faster than my reductions could reduce. So in order to keep my grade stable, I sold off the bottom at a loss. I took that hit, and it saved the grid. That's the point. It saved the grid. It saved my balance. It saved my entire trading. So now let's actually finish this up with the bot itself. We are actually looking at the bot running. The market is of course closed today, but let's look at it. Here I have my take profit and deviations. So 20 pips take profit, 20 pips level deviations. But I have something else, my equalizer, that keeps my bot safe. The part that I added, volatility, and right now the volatility of the market is 14.2 pips. So what I do is my boundary is 20 pips, then I add the volatility, so my boundary is actually 34 pips. So my total depth is 73 levels by 34, which puts me well above the 2100 pip worst case market movement in a single month. So I have the perfect system, the worst case scenario that improves my chance to survive the market. And that is what I think next week is going to be. If we do have a breakout, good. If we don't have a breakout, that's good too. Because I have a framework that doesn't depend on the market. And that is what I think next week is going to be. I don't see the market making much of a change. Not yet, anyway. I see the market saying that change is coming, but I don't see it coming yet. That doesn't mean that it's even going to give a warning. It may not. It might just decide to take off in one way or the other, and anybody that was trying to follow it is going to be decimated. But if you don't try to follow it, or I should say specifically, if you don't try to chase it, and your strategy focuses on mitigating your risks, you should do well. So hopefully that helps clarify what I think is going to happen through real world actual mathematics. Share your thoughts and let me know. Leave me a comment. What do you think is going to happen? Do you see the market breaking out up or breaking out down? Do you see the market just staying the same as it has been for the last 8 months or so? Tell me. I look forward to finding out what you think. Thank you for watching.